In the world of trading, we're always taught to chase the big moves, right? The big ups, the big downs. But what if the real genius lies in profiting from, well, from nothing at all? Today, we're diving into a fascinating option strategy that does just that. It's called the Iron Condor. I mean, think about that for a second. It's the complete opposite of what we're usually told. We're always on the hunt for stocks that are going to soar or, plummet so we can make a profit. But what if you could actually make money when a stock just sits there? It sounds kind of impossible, but I promise you, it's a very real and incredibly clever strategy. So this whole scenario, a stock that isn't really going anywhere, is the core puzzle we're tackling today. How do you actually make money from a market that's just moving sideways? It's a situation that can really frustrate even the most experienced investors out there. And this situation, it has a name. It's called a range-bound or a sideways market. Just picture a stock that's bouncing between, say, $100 and $110, and it does that for weeks on end. It's not trending up, it's not trending down, it's just stuck in this channel. This is exactly where most standard strategies just fall flat. I mean, simply buying the stock and hoping it goes up, that's not going to work. Shorting it and betting it'll fall, that won't work either. You need a completely different kind of tool, one designed specifically for a market that's stuck in neutral. And that specialized tool is the Iron Condor. Now, I know, the name sounds a little intimidating, right? But at its core, it's an advanced strategy built for one specific purpose: to generate a profit when a stock just stays calm and trades within a predictable range. Okay, so how does this thing actually work? Well, instead of betting on a direction, the whole idea of the Iron Condor is about building a profit zone around the stock's current price. Think of it like you're setting up boundaries, a safe little playground for the stock to trade within. Now, if you look up the official definition, you're going to see stuff about 4 different option contracts, and honestly, it can sound really intimidating. But here's the best way to think about it and what we're going to focus on. Just forget all that for a second. Think of it as simply constructing 2 barriers: a price floor below the stock and a price ceiling above it. So let's break down those 2 parts. First, we build the floor. We do this using something called a bull-put spread. Now, don't worry about the jargon. All you need to know is that this part of the trade is your bet that the stock will stay above a certain price. Then we build the ceiling with what's called a bear call spread. And you guessed it, this is the opposite bet, that the stock will stay below another higher price. So when you put these 2 pieces together, what happens? The space between your floor and your ceiling, well, that becomes your profit zone. And here's the really clever part. Just for setting up this trade, you get paid a premium right up front. It's called a net credit, and it's literally cash in your account. And it's yours to keep as your maximum profit as long as the stock cooperates. Okay, so that brings us to the most important part, right? The rules of the zone. How do you actually win or lose with an Iron Condor? The core idea here could not be simpler. As long as that stock price stays between the floor and the ceiling you built, all the way until the options expire, the trade is a winner. Seriously, you want the stock to be boring. You want it to just stay put. And this table here, it really shows the 2 simple outcomes. Look at that top row. If the stock price is inside your zone when it's all said and done, you make your maximum profit. Simple. But as you can see in the bottom row, if it moves outside the zone, if it breaks above your ceiling or crashes below your floor, that's when you'll have a loss. So what is that maximum profit? It's that net credit we just talked about. It's the cash you received in your account on day 1 for opening the trade. That is your best case scenario, and you know exactly what it is from the very start. But here's a huge selling point for this strategy and why so many traders love it. Your risk is also defined. Your maximum possible loss is calculated before you even enter the trade. The math is all done up front. There are no terrifying unlimited loss surprises here. Now, I know what you might be thinking. This sounds a little too good to be true, and that's why we need to have a little reality check. There is a catch, of course, and it's a really important one. Okay, so here's the most important warning. This is absolutely not a beginner's strategy. I really have to emphasize that. It involves managing 4 different options positions all at once and requires a really solid grasp of concepts like volatility. It is a powerful tool for sure, but it's meant for experienced traders. So let's run through these key considerations. First, like we said, it's best for low volatility environments. If a stock is known for making huge, wild swings, this is not the right tool for the job. It also requires active management. This isn't something you can just set and forget. You've got to watch it. And maybe most important, while the risk is defined, it is very, very real. A surprise news event could easily cause the stock to break out of your zone and lead to losses. And this all leaves us with a final, kind of thought-provoking question. We're so often trained to chase the thrill of big, dramatic, volatile moves. But maybe, just maybe, the most skillful trade of all isn't about predicting chaos, but about profiting from calm. It's a completely different way to look at the market, and honestly, a powerful concept for any trader to understand.